Good evening. Today is Wednesday, May 3rd, 2012, and this is my market recap, and I'm calling it the Fear Index Recap. And the reason why I'm calling Fear Index Recap is for one or two reasons. First thing is I gotta be careful what I say because I don't want anyone to send me any nasty letters to my office in Gibraltar. But Fear Index algos basically went rampant on the mini Dow, the NQ, which is the NASDAQ futures contract, and the E-mini contract. And what I want you to do is pay close attention to the time of this press release. Press release was at 7:40. Now, in Europe, in a tucked away place in Switzerland called Davos, there are the most powerful algorithmic trading firms on the planet that have ever existed. And once you know how the market works, you can exploit the market based upon these type of headlines. And the reason why is because when you have high-speed computers that are able to pick up these headlines via the search engines, you're able to act on placing orders in algorithmically. So what I'm going to do is I'm going to backtrack to 740 on the E-mini S&P contract. Now this is a 5-minute chart of market activity on the E-mini S&P. So this is 7:45, and you can see at 7:45 they were immediately on the ask. 477 contracts went in, 843, 739, 559, 539, and subsequently in the next 10 minutes we had a major sell-off. Major sell-off. Now this basically meant, if you were able to pick up on this, that we were going to move to the downside. Okay, now the same thing happened to the upside yesterday, because we had this headline at 3:07 a.m. and that initiated buy side activity, and that's the reason why we had the hell of a day yesterday. But anyway, Fear Index goes a lot deeper than most people realize, because to get an actual better idea, there's a guy by the name of Robert Harris that wrote a very good book on this phenomenon, and he outlines in this book, there's actually a fiction novel not a non-fiction novel, on how these hedge funds and algorithmic traders in Davos exploit the market and make millions and millions and millions and millions of dollars. But more importantly, in order to trade in these markets, you have to have certain tools, and algo tools are very important, because I mean, just if you look at today, and let's look at this chart and run through this really quickly here. If you did not get on board at the open, and this was the open, and have a short order placed here when the market opened, okay, you did not capitalize on the vertical distribution to the downside that the floor specialists and the institutional traders at the CME initiated at this time. Okay, now at the open is always where the majority of money is made for every single last trader that there is. And the reason why is because in the first half hour, the specialists place their orders in for the day, and they drive vertical distribution, whether it be to the upside or the downside. And subsequently today, it was the downside. Okay. Now, of course, the vertical distribution to the upside and the downside always stops. So, let's just run through this. This is called a TPO, time price opportunity. Vertical distribution down into 14 halves. Okay, so if you got in here, you were able to ride momentum to here. Now, if you stayed in the trade all day long, then you came to here. Now, whether or not you got out down here, that's all relative. But if you weren't in here at the very beginning of the session, then the only way that you could have humanly possibly have made a substantial amount of capital today is if you sold short in the 16 halves, which starts the very unfair high level of the E-mini S&P. So having an algo rhythmic strategy to your trading is very imperative. So that is my recap for today. Thank you for listening. Take care.